back to the House and then back to the Senate to the presidency for either veto or for signature. So we will still be in a divided governing structure, not a united governing structure, which will play out some policy dynamics that we'll have to watch and then constantly study what the policy outcomes will be and what the impact will be on different demographic and psychographic groups, along with different industry sectors, particularly in the commercial real estate and residential real estate industry. I'm going to go right to the model. It's pretty straightforward when we're doing due diligence and underwriting in the real estate industry. To be able to collect the accounting data, to be able to run the financial analysis, to understand the economics. But I think it's even become more important over the last 4 years and really the last 8 years, is to really understand the composition of not only the legislative branches, but the executive branches and what policies will be enacted. And of those policy enacted, who's going to benefit and who's going to be hurt, and what the positive and negative externalities associated with those policies will be. What I think is going to be really interesting is when my students, in the next 30, 40 years, when they become 50, 60 years old, will look back at our generation and make a decision on what was our history and what was our impact, and did we make things better in the long run for them? And that's really what I'm concerned about, is really their future. And from what I've seen from this next generation, they're going to be amazing. They're going to be an incredible generation to leave a legacy to. Years ago, I presented this to you, the dialectic. The dialectic has become even more important as an analytical tool, or a political analytical tool, especially after 9/11, basically rearranged basically institutional arrangements across the globe. You saw it again with the financial crisis. You saw it again with the election of Donald Trump. You saw it again with the election of Joe Biden. We've usually seen dialectics occur every 30 years. We've experienced 3 dialectics in less than 10 years. So we, as a society, have a lot to analyze and a lot to understand. It's just extremely challenging. I would say my ability to analyze and do economic analysis was easy, 10, 20 years ago. It is extremely difficult today. And you have to really take it again into the political economic context. If you look at the mean voter theorem and public choice theory, the spectrum of political ideology was pushed to the right, really starting with Reagan, and then it was accelerated under Bush, and then accelerated again under Donald Trump to the Trumpian populist, right. What you'll see under Biden is a movement back towards a right of center Clinton Biden policy approach. And we'll see, if the Republicans in the Senate, and we'll see if the Republicans in the House will formulate and move towards the center for policy initiatives. I'm going to go to the data right now and tell me if you can see it once I click on it. Let's see if I can do this. Okay, can you guys see the Yahoo page?
It says it started screen sharing, but we haven't.
Okay, let me try this. Oh, there we go. Okay, can you see the Yahoo page?
Yes.
Okay, perfect. So I'm going to get into the data, and I found these websites. So here's the political outcomes. So the Electoral College currently 290 to 214 for Trump. If you look at the Senate, there are still some states that are still outstanding, but currently we have a 48 majority to 46 in the Senate. So the Republicans still control the Senate with Mitch McConnell. In the House, it's 215 Democrats and 299 for the Republicans. Almost all of the House seats have already been reported. So Nancy Pelosi will be the leader of the House representing the Democrats. If you look at the election results, particularly here in California, Prop 14 was approved You had Prop 15, the change in commercial property tax, that was shot down. The California Proposition 16, which was to bring back affirmative action in college admissions, that was shot down. Prop 17 to restore former felon votes, that was passed by 60%. California Prop 18 to allow 17-year-olds to vote, although I thought that was probably a pretty good initiative. All the 17-year-olds I meet act like they're 22 and they're pretty smart. That was unfortunately shot down. Prop 19 to change the property tax rules, that was passed. That was really to carry over basis from your replacement residents for certain demographic groups. So I thought that that was probably a good initiative. Local rent control was shot down. Prop 22, app-based drivers as independent contractors, that was approved. I think anybody who's a driver for Lyft and Uber and those companies actually like the independence associated with being an independent contractor, and they were able to get some concessions on healthcare and some other benefits to circumvent the labor laws. Prop 23, the dialysis clinics, was shot down. Prop 24, expand consumer privacy, was actually passed, and Prop 25, approving replacing the cash bail, that was shot down also. If you look at just the markets today, the market was up about 1,500 on the Dow yesterday. It settled at about 850. It's up another 227 points today. So obviously some optimisms in the market. Gold is up also, along with silver. Last time I looked, the pound and the euro had actually appreciated against the dollar, and the 10-year Treasury has moved up around 30 to 40 basis points from its all-time low in September. And we'll probably see the yield curve start to steepen and higher 10 and 30-year Treasuries, which means that residential and commercial mortgages indexed to the 10 and the 30 will also be moving up, although they're still at all-time lows. If you look at the tax policies, and I just pulled this off this morning from Biden, he would probably raise the top marginal tax rate from 37 to 39.6. This will apply to people who make more than $18,000 a year and $622 for married couples. So it's really targeting the top 90th percentile, which I think is good policy. Other than bringing it down to households that make $250,000, which was basically the last modification to the personal income tax in 2013. So that kind of gives you kind of an idea. And I will assume that the most of the money that will be taken at these top tiers will probably be plowed back into some kind of medical support or some kind of subsidy for some kind of quasi public-private healthcare provision. And these are just some mortgage rates. So lock in your rates now. I'm sure Helen hears that every single day. You tell everybody every day. Some other statistics. I'm going to look at the balance sheet of the Federal Reserve. This is really interesting. This is the velocity of money. This is M1, M2. M1, M2 is the number of times cash or near cash circulates in the economy on an annual basis. It's highly correlated to economic activity and employment. And as you can see, the velocity of money, if you look at M2, has basically broken through its 1960 to 1970 support. It's seen a little inkling of uptick here, which is positive for the economy. If you look at M1, again, it has basically collapsed, and a little glimmer of hope there. But again, you're at the resistance line of the 1960s. This is due to shadow banking system and just massive amounts of public, private, and personal debt that's just sucking cash out of the system that could have been otherwise either saved or invested into real assets. If you look at the employment numbers, now, I don't know if you guys can see this graph, but this is the problem here. This was actual non-farm employment. These numbers you have never seen before since maybe 2001, you know, maybe 89, you know, uh, sorry, 2008, 2009. You got to go back to 01, 02, 03. You got to go back to the 80s, the 70s, the 50s, maybe all the way back to the 30s to see this kind of destruction, you know, in basically employment as the economy shut down. But you can see that it's bounced back, and it's starting to flatten out. And this will really, the recovery back to normal employment levels and unemployment levels will really be determined by the introduction of a vaccine. I know Pfizer made an announcement today that caused the stock market to go up 15 points. They're promising some type of virus or vaccine by the end of the year for frontline workers, and probably 1 billion doses next year. I know Johnson & Johnson and Roche and others are working, you know, on vaccines. And really the vaccine is going to really be the determinant for economic activity and really the reabsorption of commercial real estate space, particularly in downtown San Francisco and other urban centers. And I'll talk a little bit about that one when I get into the real estate section. This is labor force participation rates. You could look at unemployment rates, but they're artificially low because people roll off the unemployment benefits. So the numerator actually shrinks, and labor participation rates have been shrinking also. And you can see how people basically just left the workforce right here. And about 1 million women have left the workforce to basically take care of their kids, which is probably one of the most tragic stories in labor market history, that we've worked so hard as women to participate, you know, in the economy, to see 1 million our colleagues leave in droves. And I'm not sure, I hope we will, either through education or retraining or some type of readoption, to get these women back into the workforce as soon as possible, because just the economic costs associated with them outside of the labor force is costing us probably trillions of dollars. If you look at, this is the CPI right now, and you can see it reached 0 earlier in the year, and we're back up to around 1%. The Fed's trying to target 2, so they'll continue to print money in droves to try to meet their CPI targets, but we're not even close to being there. So the Fed will probably continue to print, you know, lots of money to try to get inflation back. Here's another thing that's really hard for me to comprehend, is on an annualized basis in the second quarter of this year, GDP, and these are annualized numbers, basically contracted about 31%, and then bounced back at 33%. These are Six Sigma events, you know, outside, you know, 3, 4, 5 standard deviations of probability, possibility. So just incredible. Will probably slow over the next 5 years to some kind of normal, but the Fed will continue to peg interest rates at 0 to do their job on the monetary policy side, to put a backstop to contractions or follow-on recessions. And then it's really going to be up to Congress, the House and the Senate and the President, to battle it out on the fiscal side, to create some fiscal stimulus, which is badly needed at this time because the economy is slowing and could enter a second dip if these guys don't pass the stimulus bill as soon as possible. This is industrial production numbers, and you can see that we started to recover out of negative territory in April and March. We got some pretty good numbers here, but we started to slide back down and went negative again. So we definitely need fiscal stimulus as soon as possible. And then the retail sector, you're going to probably see more bankruptcies in the retail sector, although retail sales have started to recover. As you can see, it was pretty bad, you know, in March and April, and you got a pent-up demand shock here, and then it started to slowly recover. And retail sales have recovered in September, which is a good sign. But how much of this is actual fundamental underlying aggregate demand and how much is just pent up demand from basically, the last 4 or 5 months, and particularly the months of March, April, and May, where everybody was completely shut down. How am I doing on time? Okay. How much time do I have, Helen?
If you want to have some Q&A, I mean, if you want to have another 10 minutes or so we can have about another 10 minutes for Q&A.
Okay, let me just burn through these stats then. So consumer confidence is increased, but is down for September. You got the leading economic indicators. They're actually improving, but those are leading. You've got the Fed balance sheet that's at a record high of about 7 trillion. So you can see all the QE that's occurred, over the years. You can see the majority of the Fed's balance sheet is made up of treasury securities and mortgage-backed securities to keep the housing market going. This is a good one, the debt clock. I would probably study this because this is basically what our kids and our grandkids and our great-great-grandkids are going to have to inherit. If you look at the REIT market, was down 13.3%, but is now showing positive gains in the year over year from the first quarter. So the REIT market actually bottomed out first and has now started to stabilize and to recover from a commercial real estate indicator. I also like to look at the NCREIF index, the Odyssey Core Open-End Fund. As you can see, it took its hit on capital appreciation and income returns. Income returns have come back, but capital appreciation is still negative. And I think this will probably go a little bit more negative and pull down the private equity real estate total returns as the fourth quarter appraisals start to come in, which is where the bulk of the valuations, reappraisal, revaluations come in. You can see the blowing out of the CMBS spreads by the different tranches. We want to get back into that 100, 150 basis point range. This will take some time, and that's why the Fed created a CMBS facility to basically stabilize, the capital flows in the commercial real estate market through the CMBS market. If you look at California's economy, right here, you can see the negative employment numbers. They're starting to slow, but they're still negative year over year. If you look at the San Francisco Bay Area, again, pretty major hit in April and May, losing almost a negative 14% loss of jobs, but we're starting to stabilize here. And obviously the tech sector is a driving force in the Bay Area. Let's look at just the commercial markets really quickly. Here I'm using CV's office report, negative net absorption. Looks like it's starting to stabilize. The bulk of the negative net absorption is coming from sublease space that's being dumped back on the market, which is really pushing up this vacancy rate and pushing down rental rates. If you look at the peninsula, it's held up a little bit better, but still rising vacancies. And vacancies will probably peak out next year as the leases roll. Economic occupancies are actually fairly healthy because tenants are still paying, but physical vacancy rates are extremely high. And they're not, I think it's Cushman said that they're not anticipating reabsorption into the office markets, probably it'll probably start a little bit in April. But they're seeing fundamentals that we saw prior to COVID. You probably won't see those fundamentals for another 5 years. And then obviously the industrial market, along with the data centers and storage, are the darling, property sectors. Retail's taken a major hit. So the architects are currently working on reuse and adaptive reuse of retail. Multifamily has held up fairly well, particularly in the suburban markets. Core San Francisco apartments, vacancies are at their all-time high. Rents are off, 20, 30, maybe 40%, depending on what submarket you're into, as people out-migrate to the suburbs and to the bordering states. And I think that's all I got. I hope that wasn't too boring for you.
Great. I'm sure that's not too boring. A lot of people would love to even probably hear more, but we do have some questions. All right. And just a reminder, everybody, if you have questions, please feel free to type it in the Q&A box. All right. So Matt Hager did say, Prop 15 has not technically been defeated yet. Can you discuss the ramification to commercial real estate if it does in fact flip and get voted through?
Okay. And is that the split roll one?
This is talking about the property tax for the commercial real estate property. So
yeah, that's the split roll, isn't it?
Correct.
Yeah. Well, the question is where are the tax revenues going to come from? I'm not talking opinion here, but I'm just talking budgetary facts. It will have a direct impact on commercial real estate valuations because taxes are part of the line items within your expenses, which will hit your NOIs. And no matter what cap rate you cap it at, it's going to have an impact on the valuations, unless you can get the rents, at the top end or lower your expenses across the other line items. The state is going to be looking for initiatives and ways to basically backfill some of the state and municipal budget holes. There could be defaults on muni bonds. There could be furloughs and layoffs, at the government level. So, the impact could be on valuations. But from a policy standpoint, the question is where the tax revenue is going to come from to basically fund education, roads, and all the other public goods. Where's the money going to come from? And usually they're going to go to real estate owners, and they're going to go to high net worth and qualified individuals to get the tax revenue. So I would just say, just wait. There's probably more drama to come.
Yeah, it seems like that's what happens, especially when we're talking about the property tax, and there's always these different propositions coming back to ask for more.
Well, there hasn't even been reassessments yet, right?
Mm-hmm.
People that haven't appealed for reassessments yet, which is going to blow a hole, in the muni budgets there too. So we could be looking at citywide bankruptcies and muni bond defaults, which high net worth individuals are the biggest investors in muni bonds.
And maybe a follow-up question on that is that if this, let's say it does flip and get voted through, will this affect a lot of business to leave California? As we know that we're already talking about all these exodus, are we going to have even more businesses leaving California?
Well, businesses and individuals have always come to California, established themselves and left on an ongoing basis. Mm-hmm. So we're seeing a pretty big, out-migration right now. But California has very solid attributes, and it'll be looked on as just opportunities for some, right, to backfill those investment holes. How long does it take? 5 years, 8 years, 10 years? I'll use a standard cycle, recovery in 2025, peak 2028, and back in probably another recession in 31 through 33. Mm-hmm. It's persistent. Yeah. So that's kind of a time frame.
Great. All right. And Maureen asked if we can get a copy of the full presentation to digest the numbers since
yeah. And again, I would review. What I'll try to do is to put together a sheet of the links, that I use to compile all the real-time stuff. I'll give you my presentation. It's pretty standard, and I do have some of the CV stuff in there, but more than happy to send it if you email me.
Sure.
And we have to do a deal together, of course.
Maureen, be sure to send a deal to Dr. Souza.
Just a little refi would be nice.
All right. And Eric asked, based on Democrat energy policies, how big an impact will rising energy costs or losing energy independence impact our economy?
That's a tough one. Well, obviously, the Democratic agenda is focused. They were the ones who wrote the Green New Deal. I wouldn't be surprised if you see another stab at that, but probably watered down and moved more to the right of center, which would make the policy more palatable, for the Republicans, the House and the Senate. So there'll probably be another initiative. I actually think that alternative renewable energy policy is brilliant. I mean, the Chinese and other countries have used alternative renewable energy as industrial policy and have basically moved ahead of us in manufacturing and servicing and consulting in that space. I really do think it's a job generating opportunity. And I think we'll just have to come to grips and move away from carbon and move towards alternative renewables. And if we can do it as soon as possible, that would be great. But I'll tell you, the next generation is coming. And when they get mobilized to vote, it's going to hit like a hammer.
Yeah, that is so true. That's so true. Okay, and let's see, Bob had asked, Larry, how will Northern California be affected by tech firms allowing remote living, aka virtual attendees versus their offices?
Sure, that's a great question. I mean, you just go down to San Francisco. I mean, I was there right before the election, and it was all boarded up. There's nobody there. So, people are working from home. Obviously, your digital realty and your hyperscale, REITs, data center REITs, the telecom REITs, the infrastructure REITs, they're benefiting significantly along with Google, Apple, anybody who's in, the telecom or in that space have benefited. Workers will go remote. Some will go virtual. I just wrote a paper yesterday on virtual open organizations, the need for real estate companies to become more tech oriented and tech centric. I think the people will want to get back into the office, but they're not going to get back into the office until there's less liability by the building owner and the employer, and mandates by the local county, health departments, and that's all going to be vaccine based. And the longer we wait, in this virtual world, the slower it's going to be able to reabsorb and get people back into these office buildings. Just as long as the employment base and the population base to continue to grow over the long run, that space will be reabsorbed, and companies will be working in a hybrid, virtual, open organizational structure. Well, they will have people on site at their real estate facilities, but also have virtual teams across the globe working virtually. So it'll be a hybrid, moving towards a hybrid model, both for real estate companies and everybody else will have to adopt it.
And I would say, like, a lot of these businesses, especially, for example, real estate, realize that we can actually reduce a lot of overhead costs by not having an office, because everything can be done virtually. And some of our clients even said that, yeah, their companies have already told them that they will be working from home permanently or part-time basis. Now, the question is, for example, Google, they are going to build in San Jose still.
Sure, and they're absorbing San Francisco too. So
yeah.
They see the opportunity.
Exactly. So it's like there are a lot of these companies, they're still building, even
Correct.
though they talked about like a lot of remote working.
Correct. Well, their employment base has been growing phenomenally. They can't get enough talent. So now that they can move, to some of their employees to virtual and bring some back, they're still going to continue to grow. So it's just basically shifted the supply constraint and moved the supply over to the worker. And unfortunately, I think the workers are getting kind of a short shift on this, because they're paying for a lot of the utilities and a lot of the costs associated with working remote without any reimbursement. And I don't know about you, Helen, but I've been working for 8 months in my house, and I think I've gone crazy 3 times, and I'm waiting to get back to the office to see my friends.
For me, I'm pretty used to working at home, and it was for me, especially for a working mom, like you mentioned earlier, it's like 1 million women have dropped off from the employment. And of course, I see firsthand, I have 3 children who are going to school right now, right outside my office. But at the same time, because of the fact that I've been working from home, it actually is a much easier transition for me. But a lot of people are not. They need to go to the office in order to do their work.
Correct. So, and they need healthcare workers or babysitters, or they need, exactly. Childcare and preschool to give them the time to work.
Exactly. And it's like just looking at a lot of teachers, they are bringing their kids to school. So there's these pots of kids at school right now because their parents just have to drop them off for daycare.
Yeah, the private schools have opened, but the public schools are still virtual.
Right. Yeah, exactly. Maureen have a question. Do you think that California will ultimately pass laws that prevent businesses from being sued by employees or customers for COVID illnesses? Employees will be covered by work comp, but suits could devastate and close businesses exponentially or increase insurance costs.
Yeah, that's a really good one. I mean, particularly for part-time workers, or quasi part-time workers that don't have health care, they got to work. So basically, they're infecting the workforce because they don't have any universal health care. And then if you do get sick and you file for workers' comp, it could take months for you to get compensation. The workers' comp system is horrific. So, yes, it could have an impact, but we have to look at the worker side too. And there needs to be some kind of healthcare and workers' comp overhaul to be able to get those benefits to the workers and be able to get some kind of quasi healthcare provision so that and disability for people so that they're not reinfecting the workforce or reinfecting the customers.
Yeah. Yeah, I'm curious about what about the CARES Act? Obviously, we had a couple of stimulus packages that came out during this pandemic,
Sure.
and as a matter of fact, IMF was just saying that, hey, United States have such a great fundamentals. Right now, we do see a lot of negative numbers, but at the same time, if U.S. Provide a strong CARES, another stimulus package, we
Sure.
are actually doing pretty well. However, obviously, our stimulus package is by printing a lot of money.
That's right.
Yeah, and the U.S. dollar is everybody was saying that U.S. dollar is probably going to be deflating. Will that affect a lot of foreign investments, coming into the United States when they
Well,
come
if the dollar is depreciating and their currencies are appreciating, it's an opportunity to buy into the United States where they're priced out either by low cap rates or high prices. Now they get a currency ability to be able to move in and be able to buy things maybe 5 or 10% cheaper just based on the currency.
Yeah.
And I wouldn't be surprised if you see some foreign investors now that the election's over, starting to move in prior to the bottom of the cycle, which is what they've done over the last 3 cycles, right? They wait and they come in right before the bottom.
And would you have any comments regarding comparing United States versus, let's say, UK investments or in Europe? Would US actually do better than UK?
Yeah, everybody wants to be here. Brexit's basically created a nightmare for the UK. Basically, Europe's going to fall right into another recession because of the lockdown. They're doing the best they can. So really, again, the United States would be the haven, which will come into our bonds, come into our stock market, come into our real estate assets. So again, the West is the best. The US is the anchor.
Absolutely. I absolutely agree with you on that. It's like a lot of people have been watching. I think foreign investments had come down quite a bit, but at the same time, they're watching what the US election is doing. And I think now that's when they decide that they're going to come back and invest in United States.
And if Biden and his team basically re-engages with Europe and NATO and maybe goes back and talks to the Southeast Asians about TPP and maybe again pushing the modified NAFTA with Canada and Mexico, we could get more gross trade flows flowing through the ports of LA, Long Beach, New York, New Jersey, and that's all going to be beneficial from a multiplier economic effect, particularly on the coastal gateway cities and markets.
That's great. And Bob has another question. What will the antitrust push affect the big tech companies, Google and Search, Amazon and shopping, etc.?
Sure. I mean, that's a great, Zuckerberg and those guys were in front of Congress talking about, monopoly powers and the enforcement, of antitrust legislation on the major, tech companies. I mean, if you go back to 1996 under the Telecommunications Act, which was basically a pluralistic policy, that was basically signed by both houses and the president at the time. That policy, we don't remember, that was 1996, but what happened in 1998, there was the birth of the internet and internet companies. And by 2000, the whole thing was exploding because of the diffusion of technologies across the economy, particularly in the startup companies. So yes, these companies have major power. They are basically monopolies at this point in time. But if there's some type of diffusion of those technologies to the broader economy, it'll have major long-lasting effects going forward, positive effects. But those monopolies are not going to give up their monopoly power easily.
Yeah, that's true. That's true. And we were talking about Amazon here in the United States, and then it's like Alibaba in China.
Sure. Sure. Well, a lot of those companies too. I mean, if you remember Microsoft and, all those companies, a lot of those employees spin out, and do their own private equity and their own venture capital, creating new technologies and new job opportunities. So really to absorb those job opportunities, you really need education.
Yes, that's true.
You need 12K education revamping along with college education. You need the HB1s to be introduced. We need labor policy.
Absolutely, absolutely. And then with the foreign policy, I'm sorry, the foreign visas program, that if they can expand that will definitely help with our labor market as well.
Along with education to train the next generations of coders.
Exactly. And Serena asks, which Trump tax cuts are likely to be repealed, and what would the process be? How likely is it that opportunity zones would get repealed?
I don't think the opportunity zones will get repealed. As I just showed you, there will probably be an increase in the personal income tax and a higher threshold of household income that you'll have to earn. That's going to be tough, for the Republicans in the House to swallow. Maybe Susan Collins or Mitch Romney will cross the aisle to make it work. But in the Senate, under Mitch McConnell and the majority of the Senate still controlled by the Republicans, it's going to be a tough slog to get it through. But from a fiscal conservative standpoint, they're going to have to address the deficit and the debt at some point in time. And the question is who's going to pay and who has the ability to pay. I wouldn't be surprised if you see corporate income taxes increase, because if you look at corporate income taxes on an effective basis, they're still at historical lows. And a lot of high net worth and qualified individuals became corporations to take the tax arbitrage by being able to lower their personal income taxes by becoming corporations.
Yeah. So if they do increase the corporate income tax, will we see more companies going back to saying like, I want to offshore some of, for example, manufacturing companies to other countries, or you don't think that will be any?
Well, I think the reshoring will continue, but now what you're seeing is basically capital labor substitution. Yes, I'm going to reshore my jobs, but really what I'm going to do is I'm going to borrow at zero interest rates and buy the state-of-the-art equipment and basically bring in blockchain and machine learning and AI to basically run my robots.
Yeah.
To offset the increased labor costs.
That is true. So it makes it more important, just like what you were saying, to have this education reform, because we have to think about this labor market completely differently for our children who are growing up right now. Is it like the old way of learning? Is it still the same? Have to teach them a lot more about entrepreneurship, and just like what you're saying, coding is going to be a big part of there.
Yeah, and I've been in education for 22 years, and I'm not convinced that basically the structural form of education really adapts to the modern employment environment. Multiple choice exams and stuff that we were using 30, 40, 50 years as assessments are not the way that these kids think, and not the way that entrepreneurial companies think either. Okay. So education is going to have to readapt their assessments and their pedagogy to basically align with the labor force of the future, which is here.
Absolutely. Well, thank you so much, Dr. Souza. I mean, you have shared so much information with us. I think this is very intriguing, very timely. So we definitely hope that, everybody can come back again. I'm sure, Dr. Souza, you will come back again and share more information next year. And for everybody, thank you so much for attending today's webinar. And until next month, we hope to see you again. Bye.
Congratulate all the new CCIMs.
Thank you so much. Bye.